Hello and welcome to Tax Matters. It is still in order to say Happy New Year once again. Yes, we are in the year 2022 and to God be all the glory. Two things happened back to back that gladdened our hearts. One at the end of the year 2021 and the other at the beginning of the year 2022. 1. President Muhammadu Buhari assented to both the 2022 Appropriation Act and the Finance Act 2021 on Friday, December 31st, 2021, the very last working day of the year. Talk about bursting the tape. Secondly, on Wednesday, the 5th of January 2022, the Honorable Federal Minister of Finance, Budget and National Planning presented the details of Budget 2022 and the Finance Act 2021. If anything, these actions go to show that the government of President Muhammadu Buhari means business. So, we are beginning today's episode of Tax Matters by sharing with you the details of the Federal Government Budget 2022, specifically the tax components. After all, the program is Tax Matters. My name is Chamako Hauchi and I'll be your pilot on this journey into the world of taxation.
I'm a very busy man. My business involves a lot of traveling and I interface with lots and lots of people and organizations. Tax compliance used to be a big drag on my business. It was time-consuming and very costly. But now, no more. Introducing the FIRS TaxPro Max, the truly fully end-to-end tax administration solution for companies' income tax, value-added tax, petroleum profits tax, and all other tax types. For fast, efficient, and convenient end-to-end tax experience, log on to www.taxpromax.firs.gov.ng. TaxPro Max has turned things around for me. It is fast, user-friendly, and cost-effective. FIRS, making tax administration as easy as ABC.
Dateline, Wednesday, 5th of January 2022. Venue, the conference room of the Federal Minister of Finance in Abuja. Chief hostess, Hajia Zainab Ahmed, Honorable Federal Minister of Finance, Budget and National Planning, and the events, presentation of the details of the Federal Government Budget 2022 and the Finance Act 2021.
I would like to speak to the forum about some of the key highlights in the Finance Act 2021, which is an instrument that is designed to enhance the implementation of the 2022 budget. Again, recall that Mr. President signed the Finance Act into law on the 31st of December 2021 alongside the 2022 Appropriation Act. The key reform areas amended by the Finance Act include domestic revenue mobilization, tax administration and legislative drafting, international taxation, financial sector reforms and tax equity, as well as public financial management reforms. There are up to about 13 laws that have been amended by the Finance Act 2021, and this includes the Capital Gains Tax Act, Company Income Tax Act, Customs Excise Tariff Act, Consolidated, Federal Inland Revenue Service Establishment Act, Personal Income Tax, Stamp Duties Act, Tertiary Education Tax Act, Value Added Tax Insurance Act, Nigerian Police Trust Fund Act, the Nasani Act, Financial Controls and Management Act, as well as the Fiscal Responsibility Act.
Coming down to specifics, especially with regards to domestic revenue mobilization.
Section 2 of the Finance Act addressed the issue of the partial rollback of exemption of shares from capital gains tax. So now the law has stipulated a 10% capital gains tax imposed on shares disposal transactions when the aggregate disposal exceeds 100 million naira in any 12 consecutive calendar months. And also, the reinvestment relief provided along with this tax is provided to defer capital gains tax where disposal proceeds are wholly or partially reinvested. So if you invest and the proceeds, you realize the proceeds of investments and you invest them, you are not going to suffer the 10% capital gains tax. But if you don't reinvest and you exit and take your money, then you pay this tax. Taxpayers are required to report disposals annually for ease of administration to the FIRS for corporate tax shareholders and to the state inland revenues for individual taxpayers. There is now an excise duty of 10 naira per litre imposed on all non-alcoholic carbonated and sweetened beverages. And this is designed to, one, discourage excessive consumption of sugar in beverages, which contributes to a number of health conditions, including diabetes and obesity. But also, this new sugar tax is introduced to raise excise duties and revenues for health-related issues and other critical expenditures. This is in line also with the 2022 budget priorities.
Other measures include...
Next slide is Section 4 of the Act, which is taxation of e-commerce businesses by non-resident companies on a fair and reasonable turnover basis, which has been set at 6% of turnover. This provision empowers FIRS to assess non-resident firms to tax on fair and reasonable basis of turnover and from digital services provided to Nigerian customers. Let me just note that such digital services include apps, high-frequency trading, electronic data storage, online advertising, and several others. The rationale for this is to modernize the taxation of ICT and digital economy in line with current realities. And this is in conformity with the provisions of the National Development Plan of 2021 to 2025. Section 30 of the Finance Act, designed to amend Section 10 of VAT as well as Section 31 and 14 of VAT, is in relation to VAT obligations of non-digital resident companies. And the mechanism that will be used is to restrict VAT obligations mainly to digital non-resident companies who supply individuals in Nigeria who cannot themselves self-account for VAT. So if you visit Amazon, we're expecting Amazon to add a VAT charge to whatever transaction you're paying. Amazon will now collect this payment and remit to FIRS. And this is in line with global best practice. We'll be missing out on these revenue streams. We're also looking at reducing tax compliant burdens on non-resident taxpayers who are not required to register for VAT. So they don't really have to come and be registered companies in Nigeria. All they need is that arrangement with FIRS where they collect VAT on behalf of FIRS and remit to FIRS. And also to clarify that FIRS may appoint persons, including non-resident companies, for the purpose of VAT collection. And to clarify again that appointed persons may collect and remit taxes to FIRS pursuant to the relevant tax laws. The whole rationale for this is to modernize the taxation of ICT and digital economy in line with the National Development Plan, to enhance administrative modalities of taxation of non-resident taxpayers, and also to reduce compliance on the non-resident taxpayers, to reduce the compliance burden.
The Finance Act 2021 has given sharper teeth to the Federal Inland Revenue Service.
As Section 22 of the Finance Act it reinforces the Federal Inland Revenue Service mandate as the principal tax collection agency. Currently, we have so many agencies, including some law enforcement agencies, that go about doing tax audits, go about raising tax assessment on companies, making the ease of doing business really complex for businesses. So this is to reinforce the lead role of the FIRS and to confirm that the FIRS is the principal tax revenue collection agency, and that they may collaborate with other law enforcement agencies of government to enhance tax collection. The tax administration reforms and the domestic revenue mobilization reforms are all designed to streamline and enhance tax collection for the country. As Section 37 is a provision for the Naseni levies, which comprises 1% of federation revenue, as well as 0.25% levy on profit before tax on major companies' turnover exceeding 100 million, equal to or exceeding 100 million in the banking sector, in the oil and gas sector, in the maritime sector, in the aviation sector, in the telecom sector, as well as ICT sectors. This provision also empowers FRS to collect on behalf of Naseni this levy. This increased funding will accrue to a special Naseni account to fund budgetary expenditure targeted on nurturing a dynamic science and engineering sector in our country. The new changes that have been brought in is to enhance tax administration and also to ensure the growth of the science and technology sector of our country.
And in a bid to block revenue leakages,
Sections 38 and 39 of the Act also reiterates the supremacy of the fiscal rules that are provided in the 1999 Constitution as amended and other exempt money acts in public financial management. The purpose is to reiterate and reinforce the 1999 Constitution as well as the Finance Control and Management Act provisions vis-a-vis management of public finances and collection of revenue. So simply put, is to ensure that all revenues that are collected will go, first of all, as defined by the Constitution, into the Consolidated Revenue Fund, and whichever agency has any levies or taxes will be paid from there. So first to the pool, and then you're paid from there. The payment could be on first line charge, but first the monies are generated into the pool. This will enhance public financial management reforms. It will also help us to reduce revenue leakages and help us to better manage actual expenditure and ensure enhanced revenue performance.
there you are, details of Federal Government Budget 2022. To further dissect the issues at stake, we have a guest in the house. Mr. Albert Folorenshaw is the Managing Consultant of Pedable Professional Services. He's a Chartered Accountant and a Fellow of the CITN. Mr. Folorenshaw has for some time now been involved on the part of the private sector in putting together in partnership with public sector the finance bills, or acts if you like, in the last 3 years. Mr. Folorenshaw, thank you for joining us on Tax Matters.
Thank you very much.
You've listened to the minister and a few questions arise. Now you'll be speaking on the 13 tax laws amended by the Finance Act 2021, capital gains tax on disposal of shares, sugar taxes, that is sin taxes, which is the 10% excise duty on carbonated drinks, and taxation of e-commerce, especially taxation on non-resident firms.
Thank you very much. Before I go into the details of those issues you have raised, let me just give a brief highlight of the provisions in the Finance Act. The first one I should mention is gain on sale of shares, which means that when you dispose of shares in privately owned equity or publicly quoted equity, the gain will be liable to tax if within a 12-month period the gross proceed is 100 million and above, okay, within a 12-month period. And of course, there are exemptions. Okay, the exemption includes for government securities, treasury bill, treasury certificate, and all that. Those will not be liable to CGT. Then number two is company income tax. Several amendments were also made in the company's income tax. One has to do with the security lending transaction, which redefine what constitutes dividend, so that for security lending transaction, all compensating payment will be treated as frank investment income. Another provision that has been clarified is the issue around the minimum tax. Okay, and so companies now who have taken advantage of the reduction in rate from 0.5 to 0.25% are now allowed to take a choice between either 2019 and 2020 or 2020 and 2021. I think that provision has effectively cleared all the issues around that. Then again, we have Section 30 has to do with turnover tax, which you mentioned, which will address the third question around non-resident entity paying tax in Nigeria. Of course, it is not a new provision. Section 30 was just amended to include non-resident entities that are engaged in transmission, emission of signals, receiving signals, e-commerce, those engaged in network platform, such that since they are non-resident entity, just like Section 30 specifically says where the profit of a company cannot be readily ascertained, or where the profit declared by a company is below what is expected, that the tax authority can assess such a company at a rate, a fair and reasonable percentage on the turnover. Okay, so that does not mean that Nigeria has adopted the DST, which is a digital service tax, as being touted by some people. No, it is the responsibility of the non-resident entity to still file their return, particularly where the activity has constituted significant economic presence in Nigeria. Such company will be required to file returns, and they are supposed to pay tax on the basis of the returns they file. It is just that the tax authority, if they think that such returns are unreasonable, may bring up the issue around turnover tax. So that is the basic highlight as far as CITA is concerned. We also have provision on VAT, okay, where non-resident entity are now required, particularly those that are engaged in online digital transaction, are required to register, particularly those that are, operating transaction that involves consumers, okay, where consumers, visit their platform and carry out transaction which cannot readily be tracked by the tax authority, but which we call business to consumer, B2C. But for business to business, the tax authority can still appoint, or still require the Nigerian entity who is expected to have been registered to still be responsible for withholding the VAT and remit it to the tax authority. But of course, the provision also says that where that Nigerian company failed to deduct and remit the VAT, the non-resident entity can be held liable for the VAT. Okay, and that is why they're saying that non-resident entity now may be required to register and be agent of government for the purpose of VAT collection. We also have brief provision around stamp duty in terms of when the electronic money transfer levy can be distributed. And of course, we have the Naseni Act, okay, which has now made it the responsibility of FRS to collect and account for the Naseni tax, as well as that of police trust fund. This is just the summary of the provision.
Thank you very much, sir. Do you think there are measures that have been put in place or need to be put in place to ensure effective implementation of all these provisions?
Well, most of the provisions, like we said, are either to be to be implemented by the Federal Revenue Service, and where it relates to individual, by the State Internal Revenue Service. Particularly, if I start again from the gain on sale of shares, those that are disposed by companies, the CGT are payable to the Federal Inland Revenue Service. And of course, it is always very obvious where a company made disposal during the year. The financial statement will reflect the disposal of investment, and it will be easy for the Federal Revenue Service to be able to calculate how much gain has been made on such disposal. A question has been asked as to, for foreign investors, will it be the sole responsibility of the of the agent in Nigeria, okay, to remit the gain on sale of shares on those foreign investors. And it is very clear. It is the agent that buys on their behalf, and stockbrokers definitely will need to account for that. Another thing that has been made in the law has to do with restriction of capital allowance. When a company has exempt income, okay, just like it was provided under Section 23, 24, Section 27 for expenses. So where capital allowance or where an asset has been used to produce income that is exempt, the provision of the law is that such capital allowance must be restricted to remove the element that relates to the exempt income. And that will only be triggered if the exempt income is at least 20% of the total income. Okay? There are complications as to what happens to unabsorbed capital allowance brought forward and how is to be implemented. But of course, we expect a guideline to be issued, by the Federal Revenue Service on how that will work.
It's getting interesting, isn't it? And very educative too. But then, time. This interview on the Finance Act 2021 and the Federal Government Budget 2022 will continue on the next episode of Tax Matters. Mr. Folorunso will still be our guest, along with one of the helmsmen at the FIRS. Watch out for it. In the meantime, the Chartered Institute of Taxation of Nigeria, CITN, is 40. Oh well, it will be 40 in February 2022, having been established in February 1982. And for this, the CITN called a press conference, which held on Tuesday, 4th of January 2022. Mr. Adeshino Adedayo is the president of the CITN.
The institute, which started on February 4, 1982, as Association of Tax Administrators and Practitioners, thereafter metamorphosed to Nigerian Institute of Taxation and became chartered by Decree number 76 of 1992, now Act number 76, Cap CITN LFN 2004, as a foremost institute recognized by law to regulate the taxation profession in Nigeria. From that period till date, the institute has grown in leaps and bounds, as the reason for this celebration of our great institute. Noteworthy is the continuous effort of our founding fathers in conceptualizing the birth of the institute, the sustainers of the vision and mission, and most importantly, the governance structure that has been able to manage the challenges, the success, and succession in leadership. CITN has continued to keep its focus on training, development, and certification of members of the profession to evidence their competency and character. CITN has also ensured that it is living up to its duty to continually enlighten and educate the public and stakeholders alike, both through members of the profession, district societies, and the institute. We do this through advisory, involvement, and participation in activities geared towards improving the legislative, administrative, and policy frameworks of the tax, education, administration, and practice. We make informed input to government, fiscal, and tax policy direction, and also update our members on emerging tax policy and related issues. These achievements and more will be highlighted in the course of the celebration event.
Mr. Gabriel Fashoto, the 7th president of the CITN, is the chairman of the CITN 40th Anniversary Planning Committee.
Come 31st of January this year, at various district level, as well as at national headquarters here, we are going to embark on tax work to create awareness of our institute. Then come February 1, 2022, we are going to have public lecture to hold at Sheraton Hotels and Towers, Abuja. On February 3rd, this year, we are going to embark on visits to IDP camps as well as orphanage and less privileged homes across the country. Then to cap it up, come 5th of February, Saturday, by 5 p.m., we are going to have gala dinner at Lagos Continental Hotel, Victoria Island, Lagos.
You can be sure that Tax Matters will follow the activities marking CITN at 40 closely and will keep you up to speed. Thank you for watching, and once again, we wish you a productive year 2022.